Idaho Technology Council presents Innovation Matters, a look at innovators, rule breakers, and thought leaders from across Idaho. From our studios in beautiful downtown Boise, here's your host, the CEO and founder of the Idaho Technology Council, Jay Larson.
This is Jay Larson with Innovation Matters with the Idaho Technology Council. Today is March 17th, 2023. It's St. Patty's Day, and we have the opportunity to have Seth Ruhter with us. Seth, thank you so much for joining us. Seth is with the College of Idaho, where he is on the faculty with the business department, and he is what I would call our resident banking expert in Idaho. Seth, welcome.
Thanks, Jay. Yeah, it's a pleasure to talk to you today.
Yeah, it's great. So, Seth, you we've kind of been through a little bit in the last week. We've probably been through a very strange time compared, from the financial collapse, which took place in about 2008, right?
Yep.
To today. There hasn't been anything like this, right?
Yeah, nothing like this.
And so we'll get in and really what we're going to talk about. But first, I want to make sure we let you know. I know you have a red beard. For those people who aren't on here, but you aren't Irish. But it's great to have you here on St. Patty's Day. That's what I wanted to make sure I got out of the way first. So, Seth, talk a little bit about your background.
Okay. So I started, in the 07-08 crisis, I was actually working for the Federal Reserve in Chicago, and I was on a team where we would actually figure out when a bank would fail because of either liquidity, right? They can't meet their cash letter, or they ran out of capital and they were insolvent kind of financially, right? That means assets, liabilities are bigger than assets, and there's no equity left. I spent a bunch of time just figuring out when banks would die. I hate to frame it this way, but essentially figure out when they die, and then they get auctioned off to the FDIC, who'd post them on eBay, and they'd get sold.
Yeah.
And then I got deeply involved in all the Federal Reserve reforms, so the stress test from a capital perspective, the stress test from a liquidity perspective. That's kind of how I made my career, and then just rebuilding the system, right, where we made banks hold a lot more capital and liquidity.
So essentially, if we equate it to human health, when someone would go through a stress test on their heart,
sure,
you sit there, try to identify when they have real problems and if they're healthy or not, and if they have to have something done to them. And you were the person that came in, analyzed the banks with the Federal Reserve, and had to say, you know what, this is what these guys are in real trouble.
That's right. It was a big team, but through kind of a big collective team. Yeah, we would. That's a problem we would try to solve and figure out.
Well, I think College of Idaho is great. Lucky to have you over there with. Teaching finance and other type of things over there, right? So.
Yeah, I think they were desperate, but
desperate.
I'll take their charity.
Yeah, I love that. All right. So now let's jump into this, Seth. So last week we had Silicon Valley Bank. Why don't we first talk a little bit about why Silicon Valley Bank is different, what their business model is, and why are they different from most other banks?
Yeah, so if you go back kind of in time, Silicon Valley Bank, they're very different from other banks. So they have a lot of the lending is a program called a capital subscription loan, and what it is it's a loan, it's a credit facility to a startup to kind of bridge the gap between their next capital raise. And so say a startup is, they've got a milestone to meet. They aren't quite there to get the next capital raise. Silicon Valley Bank would bridge that gap to get them to that milestone, with funding, so they could get that next capital raise. And so all the loans, the source of repayment was from future capital raise from investors. Silicon Valley Bank, knew the investor community, knew who was good and would provide the next round of capital. They had good loss histories, but that's very unique about their bank, and they ended up kind of small. And if you go kind of 2 years ago, that credits the business was super big. They're over $200 billion. So that's kind of Silicon Valley's business model. What's unique, if you go kind of back 2 years ago, where there was a lot of funds flowing into funds and into startups. When a startup would actually get their capital raised, they would hold it in the bank at Silicon Valley Bank. A lot of credit facilities, they were encouraged to do that, but there were some credit arrangements where they were kind of required to do that with their next capital raise. So this is a world where rates are really low, funding is flowing into the startup community. All the money is piling into Silicon Valley Bank on deposit. It's uninsured. And so Silicon Valley Bank has to figure out, where do I put the money? Because they don't have enough lending now to deal with all the money that's sitting there on deposit. And so banks have to kind of make this trade-off between, do I take credit risk? Do I take interest rate risk? How do I take risk to make a margin? They were basically choosing between, do I go 2 years with a 2-year treasury, or do I go out on the yield curve and buy 10-year treasury bonds and a bunch of mortgage-backed securities?
Now, on this part, Seth, how big is it when they're making these decisions? Because now you're at interest rates that have now changed significantly over this last 2-year period. So does that play a lot into this, into what's happening here?
Yeah, so they chose to take interest rate risk 2 years ago. So instead of lending or putting money in bonds at 2 years, 50 basis points, they went out on the curve and they invested at 2.5%, 1.5%. But these bonds have a lot of duration, and duration is how sensitive the price of a bond is to raising rates. And so that was the risk they took to try and make the spread. This is kind of 2 years ago where we didn't have we knew inflation was a problem. The Fed hadn't turned up, raised rates
not yet,
not as significantly. Yeah. But the vulnerability was created 2 years ago as, there's all this money washing around. They got all these deposits from the startup community, and they've got to go put the money somewhere to get to work and actually make a spread.
Yeah.
So that's kind of the start of this vulnerability.
And that's because it's funny when you start talking about spread, when you're really talking about 2%, 2.5. I mean, I know this is a lot of money. When you have $200 billion in a bank, and what happened last Thursday, wasn't it, where there's about a $60 billion run on the bank, and they couldn't be by depositors and other ones, and they obviously didn't have $60 billion hanging there to be able to service that, right? So
they're big vulnerability. So if you fast forward to as of December 31st, 2022, and all these bonds were sitting in this portfolio. It's designated as held to maturity. They're sitting on about $91 billion of held to maturity bonds. Those are what's sitting on the balance sheet. The actual fair value of the bonds was $76,168. If you compare that to the capital of the firm is about $15,456,000,000.
Wow!
So we have a bank that is essentially insolvent. Because so Thursday, the market figured that out. They also had a rating agency downgrade. So Moody's was kind of behind the curve in terms of they had them rated too high. They were looking at all the unrealized loss, across the industry. Silicon Valley was, the top of the list.
Right.
They had to get the ratings down to kind of catch up with where Silicon Valley was. They were going to downgrade them. They essentially had kind of a gun to Silicon Valley's head.
And so Silicon Valley had some strategies they were trying to do basically because Moody's came in and said, look, you guys are going to be downgraded. Now Silicon Valley needed to respond to that. What did they do?
And so here's maybe just the other thing really quickly.
Okay.
Their investor profile, they have a lot of uninsured investors or uninsured depositors, right? And this money's probably pretty credit sensitive to Silicon Valley's bank. So their rating is super important for their business model.
Okay, I got you.
And so, as Moody's has kind of their gun to their head, Silicon Valley has to do something to respond to either one, make the downgrade not as much, or to maybe stop it. And so the strategy was, let's sell the bonds. They had Goldman kind of helping them with as an advisor. Let's sell the bonds in the available for sale portfolio, which they did. They took an unrealized loss. That was to show they had strength and liquidity. The other issue is the held maturity portfolio. If they actually sold $1 of those bonds, the accounting would require them they would be tainted, and they would have to actually show those all. The unrealized loss in those as well. Wow. So that was the other kind of ticking time bomb that they didn't want to deal with as well, is if they had to sell those, $1 of held to maturity, the whole portfolio gets tainted, and they have to basically announce to the world. The street can see it really clearly now, right? You have to kind of dig into financials to see the HTM unrealized loss, but it would be very clear and transparent to the street. So their goal was to sell the bonds, the AFS, show they had liquidity, and then do a capital raise to try and raise capital to shore up the liquidity and to get some confidence on the rating for Moody's to either make the downgrade not as much or to maybe even stem it off. What happened, though, is Silvergate, which is another bank, that had failed or went and wound down 2 or 3 days ago. And so the whole industry was spooked with financials, and there was just questions about solvency. There was just a whole lot of the economic backdrop was not favorable.
So as you have this, now you have this, you saw vulnerability in the market. And so what happened is some of the key players then at Silicon Valley Bank started getting spooked about it and start pulling money out of it?
So Thursday, when this announcement happens, the entire venture, startup community starts talking. From what I've read in the news, it looks like the companies that banked with Silicon Valley Bank wanted to stay, or a lot of them did. It was the sponsors who are, they have real investor money in these companies, and they have kind of this fiduciary duty. We're not willing to risk investor money. And so they all told their companies that they sponsored, that they were funding, you've got to pull your money out.
That's interesting, because that's that business model you were talking about. Because the reason Silicon Valley Bank was so strong, because we always wanted to have Silicon Valley Bank open an operation here.
Sure, yeah.
Because what they had is they really helped companies start and grow, right?
Yeah,
that was their model.
Sure, yeah.
And early stage companies, and so they had loyalty probably built up.
Very loyal.
But the sponsors are what you're talking about.
The sponsors are the ones who had that fiduciary duty.
Yeah, can we go into that part at all about sponsors, or is that?
If you just think about, your private equity fund, you're funding a company, it's your equity that you're managing for investors. If that was, $5 million of deposit sitting there from the last equity raise that you gave the investors money, as is at risk, you kind of have a fiduciary duty.
And to manage that risk, and to be able to sit there. So you start saying, I'm going to pull the sponsor said, we're pulling the money out.
Yep. And if you just know the numbers, this is also what makes Silicon Valley unique. They have $151 billion in uninsured deposits. It's 90% plus, which made that vulnerability extremely huge, they're a super outlier across the banks.
Yeah, so that's so they were. I don't want to say this because it used to say you say things like a perfect storm sometimes that kind of arises, but there were so many things.
There's a lot
that were playing. The gales of the winds were coming against them. It just they didn't have a chance now, right? Because they weren't positioned and they couldn't hold off the market.
Yeah, they didn't have a chance. Thursday, when their equity price went down in the hundreds, they were 230. If you go back in time, not too far ago, there was no chance. The confidence was lost. And by Thursday, it's going across, Twitter, all these other discussion boards. The community, the fundraising community is very close, and they all talk, and so they all essentially ran to the door.
Probably, all in the door. $60 billion, were demanded. I think at that point. There's just no way they could service it.
There was no way they couldn't sell bonds fast enough. Yeah. They could. Yeah, that account went negative, I think, by probably 9 or 10 o'clock that morning, and they had to be shut.
Yeah. So now what happens now is the Federal Reserve, or the FDIC.
The FDIC, yes, FDIC
comes in, and that stands for the Federal Deposit
Insurance Corporation, and they're the ones that insure all the deposits. And they're paid by the banking community. Like those assessments the banks pay, and so it's paid by the banking community.
Yeah, and that's what people were saying, that all of these funds that were used so that like a lot of the companies that were banking at Silicon Valley Bank couldn't make a payroll if they didn't have access to those funds. And so those funds that came in from the banking community are the ones that help a lot of these companies money be distributed to be able to make that. So there were even some companies here in our valley that this impacted.
Yeah, they could, and so if you just think about kind of over the weekend, so they fail Friday.
Yes.
And then this is what happens is now they go into receivership. So the FDIC puts them in FDIC bankruptcy, and they're now got to find a buyer. Now, typically, if you go back in 07, 08, we know the banks were going to fail 6 months ago. And so they were building a package. So just think about if you're going to sell something, you're going to put a financial package together. Here's the loans. You have months to put it together. They go post it out on Bank eBay, where all they can go and bid on them and look at them.
Yeah.
So that's kind of a normal process. they now have to do this, Friday, Saturday, Sunday to put a package together, which I'm sure was a nightmare. People working around the clock. The bigger issue is they weren't able to actually get it sold.
Because who would buy it?
No one knows how much loss is in it. There's just a lot of concerns about it. And so what's interesting is Sunday, the optimal outcome, at least from a government perspective, was they got it bought. Another bank would have assumed the deposits, and they would have it would have opened as a different bank on Monday. They would have made payroll. Nothing would have happened.
That would have been the optimal.
That would have been the optimal outcome.
But they couldn't get anything together because it just didn't.
Nothing happened.
Everybody stayed away from it, right?
I don't know how the transaction, that went down, but and so Monday on Monday, you're basically racing until Asia opens, because when Asia opens, and if the equity markets in Asia trade down, it's going to spill over to the U.S. equity markets. And so they had to have something announced Sunday before Asia opened, because that would just spill right into the U.S. Open.
And that announcement was on Sunday that there was we're winding the company down. Well, Silicon Valley Bank is gone.
So Silicon Valley, they put it in a bridge bank. So that was, I can't remember what the bridge bank's name is.
Isn't Silicon Valley Bank Bridge or something like that?
Yeah, I don't know. I'd have to pull it. And so it's a bank ran by the FDIC. The other thing they did is they guaranteed all the deposits. So the big risk of Monday, no one knows if their payroll is going to be met, right? That would have spooked everybody.
Right.
They had to guarantee. So they have this authority that they can actually use. It's called the systemic risk exemption. The Treasury has to sign off. I think the Fed. I think the President actually has to be okay as well. They used that part of their authority, and they guaranteed all the deposits of Silicon Valley Bank before Asia. The other thing they did is the Fed opened the discount window. And what's kind of interesting about that is the Fed, they can't take a loss. They're kind of required, from a legal perspective, they can only lend to good collateral. The terms of that facility are very different. They're lending against the par value of bonds, which allows them to lend not against the market value, but what the par is. It's going to be a lot closer to cost.
Yeah, right.
That's a very different thing. And they're lending at 100% of the collateral value. And they're going to do it for a year. So that was the other thing to try and stem. There's a lot of, is there other companies out there, for companies that have unrealized losses in their bonds? This is the Fed trying to take that risk off the table and and give banks the liquidity to lend against the par value.
Wow. So how much is being lent right now to banks from overall?
Yeah, so right now, I can't remember the Bloomberg article, we're at 150 some plus billion that's outstanding right now as of kind of a couple nights ago.
Wow.
Yeah.
Wow, so now we've got Silicon Valley Bank, they got the Bridge Bank, and the FDIC is now running all this. What else do you see that's going to be happening in the next, what would you anticipate to happen in the next couple of weeks with this whole thing? Anything else boiling through?
Yeah, it's going to depend on what other banks fail and how the government responds. The government's going to be stuck with rate cuts probably on the table if this thing keeps getting worse.
You mean a rate cut? You mean interest
for the Fed? Yeah, because what's interesting, what's happening right now is just because there's essentially a banking crisis. Companies are slowing down; they're being cautious, and I'm sure banks are probably making they're thinking about which credits are good and bad, and it's going to be somewhat restrictive. So this is actually acting like a 50 basis point rise in rates without doing anything, just because of how this is transmitting into the banking system.
That's okay. So that's how much impact this will have.
This could have a really big impact in terms of credit availability. Right now as we speak, so it actually acts like a rate increase, even though you don't have to do it, because the banking system is what transmits monetary policy to the real economy.
It's kind of like, as you look at a funnel, it's kind of like constricting money, constricting this whole thing down.
Yeah, that's a great way to think about it. Yeah, it's like a funnel, and it's getting constricted to some degree. It's unsure, but that is restricting, which does transmit into the real economy and creates.
What's really important here is that. We'll keep the focus on Silicon Valley Bank and how we're going, but what's really important is how we see a lot of the other banks that are taking place collectively come around to help support all of this, and unify everything with the Federal Reserve and so forth. I mean, they were just talking about, because what we've seen is that we've seen inflation has started. We've had a spike in inflation, right? Mm-hmm. Because we had interest rates go up. Now we're saying, how do we manage all of these things with all of this shortage now that's going to be created in the marketplace because of the restriction in capital that's going to be able to be offered. What was interesting, I'm sorry, I'm kind of going off. Silicon Valley Bank was they would make loans and that other banks wouldn't make, right?
So I can't answer that exactly, but here's something that would just maybe be telling is I know the stories you're hearing is that they went to other banks to provide the credit, because essentially Silicon Bank is now ran by the FDIC. It's ran by the government.
Yes.
Who's deciding who gets credit. And so they're going to find to other banks to see if they can get their credit line or some similar kind of credit. And what I'm hearing is they're not able to find it at the same terms. And because of that, they're all now going back to Silicon Valley Bank. And there's this huge effort where they think, someone please buy them so we can keep doing what we're doing in the startup community.
Yeah, because that's been, they've been amazing in the startup community, obviously because of the strength of Silicon Valley. And their outreach. So, all right. So now we've got Silicon Valley Bank. How this is now impacting businesses in Idaho all throughout Silicon Valley Bank is, like you're saying, it was a huge bank.
It's very big. And it's funny. This cuts across politics and in all kinds of states. I mean, obviously Silicon Valley Bank in Silicon Valley, there was tons of stories where they weren't going to be able to make payroll.
Yeah.
Another area that's Utah, Silicon Slopes, that startup community is heavily banked with Silicon Valley Bank, and they were going to impact it dramatically also if the deposits were insured and they wouldn't be able to make payroll in a lot of these companies. And these are real people doing jobs, right? I mean, this is real people. This is affecting real people. This isn't a Silicon Valley, issue or a Wall Street issue.
We were talking about 14 years ago with Silicon Valley Bank, hoping that they would open a branch in Boise, meaning that they would really help, early stage, mid stage companies grow.
Sure.
Because they find a way to really help, be an asset and a partner with those companies, where traditional banks would come in and say, you know what, we can't lend against that; it's too risky. So what they did is they went down to at that time they had just opened up a branch down to Salt Lake.
Gotcha.
And Salt Lake had been through this whole thing where they had a fund of funds, and they had really helped grow a lot. They had to provide a lot of access to capital to be able to grow a lot of these early stage companies. And so you saw these early stage companies percolate up. And so Silicon Valley saw this as a tremendous opportunity. So that's why they came and opened it. I mean, it was in the Western United States, it was probably one of the bigger places for capital to be able to grow. And you'd see it bigger in LA, bigger in a lot of other places. So as you look at that, how's this going to kind of impact the early stage startup community in the United States right now? What are your thoughts there?
Yeah, so the degree that they're helping tons of startups. So kind of like we discussed, startups have milestones that they have to meet, and Silicon Valley Bank was kind of a bridge to get to that milestone if they needed money to get there. That source now is gone. Right, so startups' ability to get to their milestones now with a bridge with credit with a credit facility, that's a big question. They're going to be able to do that, and so it will affect credit to startups growth. I mean, it's going to ripple through to some degree because it did provide a pretty good bridge for a lot of startups to get to that next milestone. Conversely, though, I mean, it might be a good thing because it's going to make more discipline on startups, right? You've got to meet your milestones. You're got to have easy money to do that. I mean, it's going to impose more discipline as well, which can't be a horrible thing as well.
That's a good point because there's a lot of vetting processes that go out whenever a company's looking for funding or is out there, and those people validate whether those companies have it or where their weaknesses are. And it's interesting. The Silicon Valley Bank certainly did fit. They're different from all the other banks.
Very different. Yeah,
very different, and they did fit a different it's almost like a tsunami that kind of comes in, and they help provide all this access to capital, and now they're going to be, the waves kind of pull back, and we get to see what's on the beach, so to speak, and hopefully we see a lot of good things. Just really quickly on this one, let's just shift gears for one at the end of this. What are your thoughts about the innovative ecosystem in Idaho here? You guys, I'm saying this because you've helped with the Idaho Deal Flow Report. You've had students come in and help with that. You working with Blake Hansen and Alturas and with the Idaho Technology Council. What are your thoughts of the business community here, especially early stage as it goes to mid stage?
Yeah, I think it's a great community. I mean, it's been fascinating to get involved with it. Excited to keep playing a role to be helpful. I think it's, and I'm super optimistic, even though we've got a little kind of bump in the road. I'm super optimistic about Idaho, Boise, where we go. Here's just kind of just an interesting thing. Mortgages, we're very real estate driven, which drives the whole community. A mortgage rate today is about 50 basis points cheaper than it was last Thursday.
Wow.
So that's interesting, right? So if you think about and if the Fed pivots and they don't have to raise rates, and real estate's such an important driver, that could be kind of a little bit of
kind of a boost.
A boost. It could be a boost, and then we get mortgages, keeps picking up. That's kind of it could be a nice.
So there's some opportunities, but I do think what I liked is you said that it's the business community here and early stage, mid stage. Has really improved and changed dramatically over the last 15 years.
Oh, sure.
And we're seeing it. And this short-term thing that you're talking about, this window that's going on, depending upon how all the things take place, it could cause us to be able to have more scrutiny on the loans and the financial viability of a company and how you're going to invest in it. But at the same time, that scrutiny can create some good things.
I think the other part is we're not as concentrated to Silicon Valley Bank in our startups. I don't think.
Good point. No, we aren't.
We're not even remotely close, and so it's going to ripple through other communities for us.
Like a Utah.
Utah, Silicon Valley, Boston. For us, it's not really going to be an impact.
Seth, what we should do is we should have you back on maybe in a couple months. Let's take a look at this thing. Let's let the river flow, so to speak.
Sure.
And let's see how some of the actions take place, and then maybe we'll have another opportunity to maybe dissect this a little bit more. Use your banking expertise to be able to help us understand the impact of the Silicon Valley Bank, the ripple effect, so to speak. So would that be good?
That sounds great, Jay. Yeah. Thank you.
We've been very much a pleasure on the St. Patty's Day to have Seth Ruhter.
Yeah, I think Ruhter.
Ruhter. I know. I got to do Seth Ruhter here, and really one of the biggest experts on the banking community in Idaho to have join us on Innovation Matters. Again, this is really important for us to be able to follow this, so we'll keep you up to date on this. And thank you for being part of Innovation Matters, because in Idaho, innovation does matter. Thanks so much.
Thanks, Jay.
Innovation Matters is a production of the Idaho Technology Council. For membership information and to get involved, visit our website at idahotechcouncil.org. Thanks for listening and helping us transform Idaho's future together.